Hello, everyone. This is Dustin Nulf with Keller Williams Realty's, the Dustin Nulf team, and the Full House LLC, Pittsburgh Property Management. Today, we're going to take a look at how to calculate investment numbers on an income property using our investor calculator. This calculator is available on my Patreon site. The link is below this video. If you're interested in a downloadable version of this that you can use on your own, please visit and subscribe to our Patreon site. There's content uploaded there on a regular basis, as well as far as training videos on real estate in general, anything from sales, wholesaling to investing, mindset, wealth building, all that sort of stuff. So we'll check this out real quick. Let's start over here. So you punch your numbers in here. It spits you out numbers over here, and you're going to kind of be able to project what sort of sale price you want and how you're going to make a property work. So with this particular property, this is not a real property. We're just kind of punching numbers in here. We're going to assume that we're buying a 10 unit, and we're trying to figure out what the numbers are going to work at. We're going to pretend that we're paying $800,000 for it, and we are financing $100,000 worth of rehab on the property. So this is a value add property. We're going to pretend that it's pulling in $1,000 a month right now. And so we're paying $800 and we're financing $100,000. So the first thing you want to take a look at is this says sale price. However, you notice that does not say $800,000. So we're actually putting in as the sale price the total amount that we're going to be paying for this property. So it's going to be sale price plus rehab expense. Reason why we're doing that is because we're planning on buying this with standard financing with 20% down. So this assumes that we're paying for that rehab money. We're paying $20,000 out of pocket, and then we're getting the bank to finance 80% of it. So that's all worked into that sale price. Your closing cost, if you're not sure what your closing cost would be in an area, you want to call a local real estate attorney, broker, or agent and get the closing costs for that area. They can vary greatly. In the city of Pittsburgh, our transfer taxes are 2.25% on one side alone. So the transfer tax in itself is expensive. So figure that out before you run a calculation or submit an offer on a property. Our down payment's 20%. Deferred maintenance. Now, the key thing here is that this is an out-of-pocket investment is what it wants to know here. So if you're going to buy the property, like let's say if we're going to buy it for $800,000 and we're going to put $100,000 into it out of our pocket, then you would do it this way. And you see over here, it calculates that deferred maintenance expense as an out-of-pocket investment, okay? So if you're financing any sort of rehab or deferred maintenance, you're going to just punch it in, add it into your sales price, like we did here. So see how deferred maintenance goes to zero. This automatically calculates your down payment based on the percentage you put in over here. It automatically calculates your estimated closing costs based on that percentage as well. We're assuming our rents right now, gross rents monthly, $1,000 per unit, $10,000 a month. Automatically calculates your gross annual income. Management fees, vacancy. This management fee, this is what, as an owner of the Full House LLC property management company, this is what myself and my partner pay for our own properties. And this is not really a discounted rate. So if you are investing in a property like this, I mean, we're going to be around 7 or 8% probably on a property like this, all in one location. Vacancy. This is the vacancy rate on average in the Allegheny County area. So this is what it's been for the last year or so. It's a pretty decent vacancy rate. Our company is running about 3.4% vacancy rate. So if we wanted to, actually see what our actual numbers were going to be, we'd put 3.4 in here. But since we're pretending that we're buying this property, we're going to put worst case scenario numbers in here. So our worst case scenario number is if we run market on vacancy rate. Insurance, putting our estimated insurance, we pay usually around $350 per unit, sometimes less depending on how big the building is. Utilities, this assumes $70 per unit per month. That's if the landlord, us, would be paying the water and sewer. We're just using that as an estimated number. You want to be very aware of what the landlord is currently paying. We're looking at a property right now where the property looks great, other than the fact that the landlord pays $7,000 a month in utilities for his tenants. So the property right now is grossly under rented, which is, a good value add for us. However, we would have to go in and re-meter all the gas and water. Maintenance escrow, I would put 10% in there just to be safe. If you're buying a new property, it would be like 5 to 7%. If you're buying a property with some aging, mechanical, most of it's replaced, 50-50. You're looking about 10%. If you're buying a distressed property that's been beat up and you do not plan on totally overhauling it, then you should be looking at like 15 or 20% maintenance escrow on property like that. And trust me on that, 15 to 20% if you're buying a distressed property, not planning on totally overhauling it. And then if you go over that, you shouldn't be surprised. Taxes, we're estimating based on the full purchase price what the taxes would roughly be. In around the city of Pittsburgh, it's something like, I think it's 2.3%. Could be more, 2.4%. Other expenses, this one we're assuming that there's going to be lawn care and snow removal at $400 a month. Turnover rate, this assumes that every year at least 2 of the units are going to turn over on average. Some years you might have 1 or none. Some years you might have 4 or 5. Our leasing fee is 100% of first month's rent. That's pretty common in the city of Pittsburgh. We have relatively low rent rates right now and for the last 30 years. So leasing fee, if you get a discount from your property management company or whatever, you're going to want to adjust that there as well. We did a calculation on a monthly mortgage. We used mortgagecalculator.org. I'm going to switch over real quick. Here's mortgagecalculator.org. This is the numbers we ran. We did a 20% down payment, 5.5% interest rate, 20-year term. Put all our property taxes and stuff to zero because we already calculated that. And then that's what our monthly payment would look like on a 20-year term. So back over to here. So that's our monthly payment. This is our term, 20 years. This is how much we expect the property to appreciate in value annually. And it depends on the area. I think the national average for the last 100 years is somewhere around between 4 and 5%. So this is an underestimate. So this whole thing is a very conservative estimate on this property is what I would call it. There's things where we should be able to do better on, such as the vacancy rate, and we might even be able to discount our management fee if that's really a deal breaker. So the way this works out, we look over here. It's calculating everything for us. Here's our total expenses. Here's our net operating income. Here's our cap rate, debt service annually, cash flow. This isn't such a great look at property, so we'd have to figure out, what do we have to do in order to make this property cash flow? Do we need to change the sale price? What? And for example, in this one, we're going to take a look. When you're buying a property, you might actually look at this and be taking this to a bank and be pitching the value add side of this. And if we're pitching the value add side of this might be our current numbers, but if we go and we just copy this whole thing right here, and we go over to the pro forma tab, we can pop this into the pro forma tab. And then we go in and we say, well, what's our value add and how's this going to look after we do the value add to it? So in this scenario, we're going to assume that we put our $100,000 in rehab. We're going to be able to put that in, and we're going to get an extra $200 a month per unit out of it. So we're going to get $12,000 per month once the rehab's done. And then all these other numbers we're going to get to stay the same, right? Or we might even pitch, we're going to go in and fight the tax assessment. We might get that down to $20,000. And then that's what our cash flow looks like here. It's over an 8% cap rate. That's a pretty good looking property then at that point. And then I left this spot here where you can go in, and if you want to, you really kind of want to outline what your pro forma is. So, we go in and we fix up some of the units, and we're going to be able to up the rent by $200 per month. And we're going to also get the taxes reassessed, so we're paying $4,000 a year less than what we are now. And you're going to outline that there as your pro forma. And then this is a very simple, spreadsheet that you could take to a bank and show them how it's going to all work out. And you can use it to find partners or calculate a deal. So that's that. Again, visit my Patreon site below the video. Subscribe, you get access to this downloadable version. You're also going to get access to all the other training videos and stuff we have on there. We're going to have some longer, hour-long sessions where you're actually going to be able to sit in on actual trainings that I give in person. And if you ever need any property management in the Pittsburgh area or sales help, feel free to reach out to us. We'll have links for that below this video as well. Thanks for watching.